and welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, the 8th of May, and I've got Phil here. It's the usual team together.
It is. You're back, Andrew.
Yeah, I'm back. I was away last week, wasn't I?
You were.
Having such fun. I do enjoy it. But there you go. Right, how are we going to start today? Actually, I'll tell you what, there's a couple of things I want to talk about today because I've been talking to other people about it. So I will just have a little bit of a rant and a rage, so to speak. Not rant and rage, but a little bit of chat. Before we get there, just obviously, we do record this at 12 noon. We're running a couple of minutes late because we just wanted to see what the Bank of England did. And as predicted by just about everybody, they've cut by 0.25% to 4.25%. So that will keep everybody happy, and we'll probably get another couple of cuts later on in the year. Whereas in America, of course, they haven't had an interest rate cut, even though Donald Trump wants them to, because, of course, the Fed is very sensibly saying, the problem with these tariffs is it's going to cause inflation. And the only way to combat inflation, or the only tool they've got, is to keep interest rates high. But, of course, if you keep interest rates high, that means the cost of your debt remains high. Now, that's important, Phil, because I've been talking to a lot of people about these tariffs and what's going on. A lot of people come up to me and say, Andrew, why are they doing it? Why are they putting all these tariffs on? What is the purpose of it all? And I've basically been trying to explain to them in the way that I do that actually it's actually not really a tariff war. It's all about debt and your percentage of debt to GDP. And also that ties in a little bit with the amount of money you're spending on your military. And when your expenditure on military becomes too high and your debt becomes too high, everything starts to go wrong. Now, if you look at the US, its debt is completely out of control. And that's causing a problem. And so what Donald Trump really has been trying to do is, it's nothing to do with tariffs. What he's trying to do is get the debt to GDP level down to an acceptable level. Now, he is, these sort of tariffs could bring in 300 billion, I don't know. Elon Musk, obviously, with his Dodge plan, is trying to save a couple of $100 billion. Bring interest rates down, that could save 100 billion. You could see how you could take almost $1 trillion of debt out of the system, which gives you a lot of playroom. So what I would say, and that's why Donald Trump is so keen that American interest rates come down, it reduces his problem with his debt. And so these tariffs, it's not really a trade war. It's all about reducing US debt. The problem is, and where Donald Trump has gone wrong, is there's an old physics Newtonian law, which is, I'll let you finish it off, but every action has an equal and opposite
reaction.
Correct. Now, we all know that from basic physics. And this is the issue that he's having. So it's fine. He thinks, okay, the action put on tariffs, that'll help me bring the debt down. But it has an equal and opposite reaction, which is going to cause inflation, which takes interest rates up and then takes the debt up. I.e., it's not as simple as he thinks it is. Now, how actually should you get over it? As you know, I've discussed on this many a times. In my view, Bretton Woods is all over. We're not celebrating, but we're remembering rather 80 years from VE Day today, and which is a very important thing to do. We should always remember what so many people did to give us the lives that we've got. And at the end of it, there was Bretton Woods, which sort of created this stable world, trade agreement, free trade, global free trade, the dollar as the global currency. It's all over. But what we actually need to do is have a Bretton Woods 2. And what you need is actually for Donald Trump to sit down in a friendly way with China, maybe Russia, maybe Saudi, maybe India, Europe, and actually create a new Bretton Woods 2 that puts the whole world and resets everything, because we've all got into a problem. And that's my advice. And where we are. And that's what I've been talking to people about. Anyway, that's that one. Do you agree with any of that, Phil? What do you think?
I don't disagree. It is all about the debt, and you're spot on. Debt to GDP, all about budget deficits, all about where they can make savings.
Mm.
And I think the US debt to GDP ratio, Andrew, is it nearly 200%? I can't remember,
Oh,
it's significant. So
it's crazily out of control. That's the big
yes,
problem.
something needs to be done. You also, you mentioned defence as well. The US defence expenditure, which is like $850 billion, trying to reduce that and obviously get regions like Europe to pay more for their defence. So we're
So
already
then
go on.
that's that. The other thing I've been talking to a lot of people about is I think most people who listen to this podcast know that I'm a reform supporter. I was one of the first members to join, and that actually we have pretty good access to reform backers. But what I've been saying to people is, look, I think that reform are going to get into power in 4 years' time, if not beforehand. And the only way they won't get into power is people start using reform policies. And I noticed one that's sort of being talked about a little bit at the moment, and that is that Nigel Farage obviously has a very different view on natural resources and transitional energy and net zero to, shall we say, Ed Miliband. I think most people know that. I think Ed Miliband's a complete and utter idiot. The way he's handling net zero is completely wrong. I'm not saying that an ideal to head towards net zero is not right. And as most people know, I believe in solar wind batteries will be the future. But it's the future because they will be the economically most viable form of energy, not because we want to go green. But in the meantime, you're still going to need gas. And so I believe that actually when reform get into power, yes, it's 4 years away possibly, you will see the North Sea switch back on. You will see all sorts of things happen in terms of incentives to get British gas. I don't mean the company, call it UK gas, our own gas produced again. So we're not having to buy it off the Norwegians at ludicrous prices. But that isn't the end of transitional energy. Transitional energy happens because it will be the most economic form of energy. But I think people need to start thinking, okay, what will reforms policies be and how will they impact our business? Because it's going to happen. It's always good to try and predict the future. Maybe I'm looking too far out. What do you think, Phil?
Well, there's been quite a bit of news flow on this week. Particularly, was it Orsted pulling out of a big development?
Yeah, they did. They pulled out of a huge wind. They just said it wasn't economical anymore.
Yeah, because of the cost of that involved. I also saw that a big
They've written off.
oil.
I think they wrote off, by the way. I think it was about $450 million or something, wasn't it?
You are correct. Yes,
Yeah.
it is. Yeah, it's nearly $500 million written off on the project. Also saw that a large oil services company in Aberdeen was making redundancies this week. Was it the oil company up there in Aberdeen making redundancies?
Well, actually, I think it was an oil company, wasn't it?
Yeah,
It
it's
was
oil.
Harbour Energy.
Yeah,
I mean, this is tech and transitional energy, not oil. But Harbour Energy did lay a load of people off. But interesting enough, they also put out a trading statement, which was quite upbeat. But it was upbeat because all of their oil and gas is going really well elsewhere in the world. It's just in the UK where it's all going wrong. God, someone get a. I mean, no, we're not supposed to be
no,
things we
Andrew,
shouldn't say. But
you're
Ed
all right.
Miliband needs to go. Um, careful what I say.
What was it to say? Moving on swiftly, Andrew.
Yeah, moving on swiftly. Come on, let's. What news have you
Well,
got? It's been a bit of a. Obviously, it was a bank holiday weekend. So
yeah,
it was beautiful weather, and there's been a lot of trading updates actually coming out from companies in general, which in general have been pretty good. Um, but it's been, I would say, quite quiet on the transitional energy front. Although the National Wealth Fund, of course, this morning did make a pretty huge investment into Iberdrola, which is that's Scottish Power. They've got. So I always forget which ones they own.
yeah, Scottish Power.
To put in they want to lay a cable between Scotland and England, don't they? And it's going to cost 600 million or something.
Yeah, that's it. Yeah.
God, they should have called me. I'm sure I could have done it cheaper.
Yes, that will be diversifying your business, wouldn't it?
Um, anyway, that's managed to spend lots of the National Wealth Fund's money. They've got a lot of money. They can never seem to be able to spend it. If they could just put it into small cap companies. Do you know what? In this country, it drives me insane. I told you I was going to ramble on this morning, but we have so many amazing technology and transitional energy companies with great product who are just so starved of capital because the issues in the London stock market and actually in stock markets in general, the de-equitization. If only the National Wealth Fund was able to fund some of these brilliant companies. Do you know? I mean, here's an interesting one. Arm, as you know, I have my regular annual lunch with Arm. Today, Arm would not be successful because it wouldn't be able to get hold of the capital that it needed when it did need it back in the 90s, and I was there raising it for them. Today, they wouldn't be able to do that. I'm not sure Arm would be successful in today's environment. And that is a terrible, terrible thing to say.
Yeah, well, it needs to get fixed. I mean, I remember sending you earlier in the week the City AM report that even Series A funding in the UK fell in March to 2.4 billion, which was a 500 million drop
Yep.
on the prior year.
Which
And
was a drop
also,
on the prior year.
yeah, well, there we
It
are.
just keeps dropping.
Keep, keep from. Anyway, now listen, you. This is a City AM article, and it was data from a company called Venture Path, actually, who compiled this data, but also Series B investment was flat as well. So mirroring what you say, I mean, it's not just the public markets; this is now the private markets as well. So something, as they say, needs to be done. But keeping on the subject of Andrew, you mentioned defence and the US defence expenditure. I did see this week that defence company called Tekever, which is UK Portugal based, attracted investment of 70 million euros from various VC funds, including a NATO Innovation Fund, and they're going to invest 400 million into the UK, 1,000 jobs, and it's defence tech for drone technology. So I did see that. And again, on defence and reflecting a potential shift in, increasing spend in Europe was BAE Systems. They had a market update as well, trading in line with management expectations, guidance maintained, and strong order books. So if you saw that one, so that was pretty good. Also, Renishaw. That ticket is RSW, originally founded from engineers from Rolls-Royce that founded Renishaw. Shares are up 16% today. Renishaw has patented measurement probe technologies, and their probes are used widely. You go around any advanced engineering plant, automotive plant, aerospace, aircraft makers, you'll see Renishaw probes there being used to measure engineered structures, and they were reporting a 9 months to March trading update. They upgraded their outlook. They also said Renishaw was really interesting as well. Andrew, it's one of the first ones. Well, first of many, I'm sure, commented on tariff impacts. And they were quite specific about this, saying that the USA is 20% of their revenues. They've got factories in the UK, Ireland, and India. Said degrees of uncertainty, but they are introducing a surcharge to try and pass on the impact of the tariffs to their client base. And they also commented on UK national insurance changes as well, Andrew. Subject close to your heart as an employer, I'm sure.
Well,
But
yeah, they're kicking in, but also I think we're about to do a US UK trade deal this afternoon.
yeah,
So who knows? That could all change again.
Yep. So that was, yeah, indeed, and so that was in aerospace and defence of a Renishaw. Also, Filtronic, company we commented a lot on this podcast.
Yeah.
Yep, that Tekever's FTC. Their shares are up 35% year to date. So Filtronic's radio frequency electronics goes into aerospace, defence, also space applications, and of course, they've been very, very successful working with Starlink, the Elon Musk network, when Starlink invested in Filtronic. They have said that outlook for 25 and 26 is expected to exceed current market expectations. And good. This is really good to see as well. I mean, they're investing in increasing their manufacturing capacity in the UK. They're taking on extra people in the UK. All the things we want to see happening. So that was very good for Filtronic. Other one was in transitional energy, ITM Power, Andrew.
Yeah, they had another. Well, they've had a few announcements, haven't they? But they had another one this morning.
Yeah. And I mean, the shares are up by 27% last month. They're down 2% year to date, so they're recovering. And they've been selected by, so ITM Power's electrolyzer technology for hydrogen, and they've been selected by Germany-based Uniper for a 120 megawatt green hydrogen project. I mean, Uniper looks like, I don't know, I've come across Uniper before. I'm sure you probably have, Andrew, but they've got energy generating capacity, hydro, gas, nuclear, and coal, 19 gigawatts of capacity. And this project is for the Humber H2 green hydrogen project in the UK. It's shortlisted for government funding and the hydrogen allocation round two, but it is subject to final investment decisions expected in 2026 and targeted to be operational 2029. So that was that. I also spotted. You see that FD Technologies in software tech, and it was FD Technologies. The ticker is
Taken
FD.
over.
Yes, another one. So this is
Another one's gone, and another one's gone.
another one. This is
Like,
TA Associates, a US-based private equity company, is bidding for FD Technologies. The bid, it looks like the board have today announced that they're accepting it. It's £24.50 per share. And what's always noticeable is the price being paid for these quoted companies on the UK market. And in this case, the cash offer, is a 47.8% premium to the closing price on the 21st of March. And 50.9% premium to the 12-month weighted average price. That's how much our companies are getting undervalued on the UK stock market at the moment. Yeah. So
they are undervalued, but the trouble is you need a bid to get the value because there's just no pools of capital out there with the institutions. Not every stock is going to get bid for, unfortunately.
no.
Never seems to be the stocks that I own. Anyway, that's not totally true because I owned Aquis and that's been bid for. So I could do with a few more bids in my portfolio, has to be said. But it does make you wonder where the hell. I mean, I've been saying now to quite a few people, and actually I had a conversation with the FCA the other day, who said, where's the stock market going? And I said, well, look, in 20 years' time, there won't be a stock market. Unfortunately, I think technology will take it over. You don't need it. I mean, the London Stock Exchange Group has realised that only 4% of their turnover is the London Stock Exchange, which is pretty appalling. They're a data company. But why do you need a stock market? There's no liquidity in it anyway. You may as well go private. We're seeing these platforms like JP Jenkins do private companies. Even the London Stock Exchange is trying to create a platform for private companies. But actually, you think about it, if you're a big company, you could just have a little button on your website and say, look, if you want to trade the shares, we'll do an auction at the end of every day, put in your bid and your offer, and we'll match it all up. Technology is just taking it all away. And the rules and regulations and the costs of being a listed company, it's just not worth it if you're sub, I don't know, 200 million probably, because it is just so expensive. So, I mean, look, it's still here today, but the number of companies on the market is shrinking by the day. I don't know, maybe we'll keep the FTSE, maybe we'll keep the ST250. That'll be like the Champions League or the Championship and the Premier League. But under that, no, it'll all become, amateur football, amateur stock market, but not amateur in like that. But, it'll be private and you'll just trade it through their own website. And actually, if you want exposure to things, you can buy derivatives or ETFs or whatever you want. You just go on to somebody who'll create the product. I think in 20 years' time, we may not have stock markets. There's an interesting thought to end the podcast on, Phil, isn't it?
Well, it is. 20 years' time, I'll probably be in an armchair, Andrew, nodding asleep and retired. But there we are.
I'll still be on the golf course or the squash court or the paddle court or the tennis court or the bicycle. I'm not going to stop, Phil, right until,
I'll still play at golf when I'm 80. There we go.
All right. That'll do. I think we've heard all the news. I hope people enjoyed it. If you've got comments, do write them in. If you've got questions, write them in. If you disagree with us, write them in. Come on, let's have some interactive conversations here. Thank you very much, and we'll be back next week.
Chat again next week, Andrew.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.